What is yield farming cryptocurrency? Yield farming, also referred to as liquidity mining, is a way to generate rewards with cryptocurrency holdings. In simple terms, it means locking up cryptocurrencies and getting rewards. In some sense, yield farming can be paralleled with staking. However, there's a lot of complexity going on in the background. In many cases, it works with users called liquidity providers, LP, that add funds to liquidity pools. Yield farming is typically done using ERC20 tokens on Ethereum, and the rewards are usually also a type of ERC20 token. This, however, may change in the future. Why? For now, much of this activity is happening in the Ethereum ecosystem. However, cross-chain bridges and other similar advancements may allow DeFi applications to become blockchain agnostic in the future. This means that they could run on other blockchains that also support smart contract capabilities. Welcome back to our channel. If you have not already, made sure to hit the subscribe button and ring the bell so that you will get notified every time we upload new video. What are the benefits of yield farming? The age of disruption continues this 2021 since the early days of Bitcoin and its underlying blockchain technology over a decade ago, with no signs of slowing down. Decentralized finance, DeFi, and yield farming took the forefront last 2020, starting the year with a decent $620 million in the pocket, but ended it in a loud bang with $18.5 billion in TVL, or total value locked in assets. We can confidently say that there is no turning back to the obsolete ways of doing banking and finance. In daily headlines, we can see how governments are beginning to regulate the onslaught of permissionless protocols that are inevitably disrupting the present and redefining the future landscape of global financial systems. The blockchain revolution empowered the development of DeFi projects based on cryptocurrencies, native coins and tokens, smart contracts, and non-fungible tokens, or NFTs. As we have infinite ways of doing business online, we were also exposed to earning as much with what we already have, our funds. Today, we take the case of yield farming. What are the risks of yield farming? In several of our recent articles, we have discussed yield farming. I published the yield farming guide and then created a tutorial on how to do yield farming on Upswap. As explained in those articles, it is quite profitable. However, there are several risks of yield farming. Any investment that offers medium to high rewards has risks, and yield farming is no different. That is why in this article, I will show you the risks of yield farming and liquidity mining so you are clear on what you're going into before you proceed. Impermanent loss risk is one of the biggest risks of yield farming. When farming yields on your assets, you add liquidity in pairs of equivalent value. If you add 1 ETH in an ETH/USDC pair and 1 ETH is 2000 USDC, you must add 1 ETH and 2000 USDC. However, crypto is volatile and can affect the fiat value of your coins at the end of the day. Risk of impermanent loss. Impermanent loss risk is one of the biggest risks of yield farming. When farming yields on your assets, you add liquidity in pairs of equivalent value. If you add 1 ETH in an ETH/USDC pair and 1 ETH is 2000 USDC, you must add 1 ETH and 2000 USDC. However, crypto is volatile and can affect the fiat value of your coins at the end of the day. Suppose the value of ETH falls to 1000 USDC, the coins in the entire liquidity pool shift to make up for that. When you have a huge loss in any of the coins in the pool in such situations, you can end up with an impermanent loss where you get a lower value than what you put in when you withdraw your liquidity. DeFi smart contract risk. Smart contracts control yield farming and DeFi. One bug in the smart contracts can cause the price of a token to drop to zero. A malicious hacker can exploit that bug or security issue to manipulate the project for any possibility, including losing all your cryptocurrency assets in the pools affected. To mitigate this risk, confirm that the smart contract has been audited. Good DeFi projects get smart contract audits. Liquidation risks. You risk liquidation risk the moment you consider pulling out your money or crypto from the pools or projects. This isn't exactly a risk problem, but a strategy problem. For example, If the worth of your coins in a pool is $1,000 and the value keeps going down, there are two options: pull it out or stick to the pool. Unfairness. Yield farming pools are controlled to a large extent by the founders and wealthier investors. That puts yield farmers with small funds at risk, because if a wealthier investor takes out a large chunk of their investments, it can affect the platform. Risk of scam. When considering yield farming pools and applications to use, you need to be careful. Anyone can create an app for yield farming if they have the necessary skills. You must ensure that you are not using an app that isn't properly vetted or the owners aren't known. You can still check online for comments because, in most cases, there would be some publicity about the app before they launch any liquidity pool. So, check GitHub, Twitter, and Reddit to see if there are negative comments. Gas fees. Gas fees on Ethereum are high. This is one fact that no one can debate. This is a problem for DeFi yield farming, especially for investors with smaller funds. Wealthier participants might not mind. When a lot of people take advantage of a yield farming opportunity and lock a lot of cryptocurrency in DeFi, gas fees skyrocket. In 2020, this was a big issue where gas fees reached over 100x more than usual due to yield farming activities on Uniswap. When such happens, those with fewer funds would realize it's costly to withdraw their earnings and might end up losing money if they try. If they choose to leave the cryptocurrency in the pool, any other risks, such as impermanent loss and liquidation risks, can lead to a loss. Ethereum 2.0 with Layer 2 scaling aims to solve this problem. Bugs in the code. Every app has bugs. Even when the developers do their best to ensure they don't, they can miss some of these things. For most top applications, such bugs don't cause much impact most of the time, but sometimes they can be serious. A malicious actor can exploit such issues to their advantage, making all investors in the yield farming pool lose their money. Price risks. This risk is not particular to farming yields on your cryptocurrency assets. It can happen to any crypto investor. As long as you hold crypto, you risk price risk, meaning you are liable to the risk of losing your money. Price changes happen a lot in the market. If the value of the coins in the pair you provide liquidity lose value, you would lose some of your money. There is also the aspect of the token. Some yield farming platforms offer their token as part of the rewards to yield farmers. If the value of the token falls, what you expect as returns for your investment reduce. Strategy risk. When doing yield farming, your strategy matters. You have to decide on what kind of pair to invest in. A hot pool today wouldn't be hot in a few weeks from now. Here's the thing, if a pool provides 2,000% returns, which usually happens at launch, in a few weeks, that can drop to 300% because more money would have been pooled in by then. People would find out about that pool and invest, and as more people invest, the returns would reduce. Best coins for yield farming: compare the coins that pay back the highest yields. One of the hottest trends in cryptocurrencies is a financial activity that dates back to biblical times: lending money to earn interest. Instead of just waiting for their Bitcoin, Ether or other digital coins to rise in value, cryptocurrency investors are now actively chasing returns by lending out their crypto holdings or pursuing other strategies to earn yield. Such yield farming can earn double-digit interest rates, far higher than the rates one can get with dollars. It is a high-stakes endeavor. Investors run the risk of having their digital wealth stolen by scammers or erased by sudden bouts of volatility. The space is also largely unregulated. Yield farmers aren't protected by the Federal Deposit Insurance Corporation, which compensates depositors when banks fail. Meanwhile, companies such as the exchange operator Coinbase Global Incorporated hope to benefit from lofty cryptocurrency interest rates. Last month, Coinbase announced a program in which customers can earn 4% annual yield on stablecoin USD coin. And the yield is low by crypto standards. BlockFi, a crypto lending startup, offers depositors a 7.5% annual yield on the same coin. It's getting more accessible to people who aren't crypto native, said Peter Johnson, a partner at Jump Capital, a venture capital firm that has backed BlockFi and a number of DeFi projects. Thanks for watching. Don't forget to subscribe and turn the notification bell on.